Howdy, Jacob here. Today we're looking at Federal Signal Corporation in the machinery industry, 5.7 billion market cap on just under 5.9 billion enterprise value. So a little bit of net debt here. Growth of the business is over double the last 10 years. Looks like that is pretty cyclical though. We do see 3 years of revenue decline, but then we also see 3 years of the last 10 years with over 20% year-over-year revenue growth. Gross margin relatively consistent, around 26%. Operating margin, again, relatively consistent in that 10 to 14% range. Earnings per share going up fairly consistently. Dividend, they are paying a dividend, but it's a very minimal amount in relation to earnings per share, so they can definitely afford it. Return on invested capital has almost been over 10% every single year the last 10 years, just one minor year in 2016 of 9.7%. Pretty solid. Let's look at the income statement. Most of their expenses are cost of goods sold. Makes sense. No R&D. Balance sheet shows 61 million cash on hand, 4 million short-term debt, 294 million long-term debt. Let's see, roughly 250 million long-term debt. That's very minor in relation to their free cash flow. The use of free cash flow on capital allocation standpoint is mostly acquisitions. And then we do have some debt reduction, some dividend payout, and some share repurchases. Looks like the share repurchases are really just offsetting stock-based compensation, and the dividend is paying out less than 20% of free cash flow. So that's enough to get me to make some assumptions here. Don't need to go into any depth here too crazy, it looks like. For revenue growth, spending some money on acquisitions, probably still able to grow at a 7% rate of return. Since they're growing through acquisitions, usually acquisitions are usually not very advantageous from a return on invested capital standpoint. They definitely can be. They can definitely hit the bottom line when synergies occur and you really efficientize the business, but in most cases you're overpaying. And so when the organic growth is pretty much in line with inflation, I'll probably go right around market average here. For margins, historically, the net income has been higher than free cash flow, which I don't like as much, but hey, let's go 7 and 6%. Maybe that's a bit too conservative. 8 and 7% share change, like I said, just pretty much offset stock-based compensation with their share repurchases, and a dividend that they can definitely afford. Historically, haven't increased it too much, so let's increase it roughly 5% or so. And it needs to fall, stock price needs to fall 74% before you get the return we're looking for here. So I think good business, growing through acquisitions, not as attractive as I would like, but we are seeing pretty consistent bottom line margins, which is making me more comfortable with the capital allocation going towards acquisitions. But I do prefer companies when they age to become more efficient, meaning that bottom line gets as closer and closer to that gross margin as possible. Obviously, there's going to be every business and sector is going to be different, where you can't really, really narrow down that gross margin as much as possible. You're going to have other expenses, sales, general and admin, research and development and such. But for businesses that aren't growing very much, you just want to make the business as efficient as possible. And, it is pretty close, 13% on the operating side, 26% on the gross margin side. But I think we can see some more efficient use of capital here in my eyes. So 74% drop before you get the return we're looking for here. So I'm going to wait a little bit before I do some research and look at other companies in the meantime. Hope you enjoy the day. Have a great day.